I'm joined now by Assistant Commissioner Small and Medium Enterprises, Matthew Umina, who has an update on Division 7A. Welcome, Matthew.
Thanks, Tracy.
Now, Matt, the previous Division 7A webcast was released back in October 2010, around the same time as the finalisation of Law Administration Practice Statement PSLA 2010-4. You have an update on this for us.
That's right, Tracy. The practice statement was finalised on the 14th of October 2010. It outlines the way in which the Commissioner intends to administer Taxation Ruling TR 2010-3, which was issued on the 2nd of June 2010.
And a link, by the way, to both the ruling and the practice statement can be found on the same page as this webcast. But Matt, how different is the practice statement to the draft?
Tracy, the practice statement is significantly different to the draft practice statement PSLA 3362, which was released for public comment in early 2010. Just like Taxation Ruling TR 2010-3, the draft practice statement generated a lot of interest and we received a lot of feedback on the draft practice statement. Now, we took all the feedback into consideration before finalising practice statement PSLA 2010-4. The final practice statement outlines the circumstances in which the Commissioner considers a Section 2 loan, that is, an ordinary loan, would have arisen. It says that the Commissioner will look at all available documentation, including, but not limited to, written agreements, how the transaction is documented in the financial accounts, to form an initial view as to whether a Section 2 loan exists. Of course, the taxpayer is invited to furnish evidence showing otherwise.
And are there concessions to taxpayers who perhaps inadvertently triggered a Section 2 loan and can't provide evidence that shows otherwise?
Tracy, we recognise that it is often difficult or costly for a taxpayer to provide such evidence where the unpaid present entitlement, or UPE for short, is simply misclassified as a loan. With this in mind, the practice statement now provides two self-corrective options for taxpayers who have either misclassified UPEs as loans or small business taxpayers who have failed to comply with Division 7A in respect of a Section 2 loan, that is, an ordinary loan.
And what are the self-corrective options?
Firstly, there's an ability for private company or trust to correct the accounts where a UPE has been misclassified as a loan. And secondly, there's an ability for a taxpayer to self-assess whether it would be reasonable for an ATO officer to conclude that the Commissioner's discretion in Section 109RB should be exercised in the taxpayer's favour. Taxpayers can take advantage of these self-corrective options as long as they satisfy the conditions which are listed in the practice statement.
And what's the effect of the self-corrections?
The effect of the first self-corrective option, that is the ability to correct an amount of UPE that is misclassified as a loan, is as though the error never happened. The effect of the second self-corrective option, that is the ability to self-assess the application of the Commissioner's discretion under Section 109RB, is to reduce the need to formally request that the Commissioner exercise his discretion under Section 109RB to disregard the deemed dividend.
All right, and is there a deadline for the exercise of these options?
A taxpayer wishing to utilise either of the self-corrective options must take all appropriate action on or before 31 December 2011. Having said that, a taxpayer can always apply to the Commissioner in writing, requesting that the Commissioner exercise his discretion under Section 109RB to disregard a deemed dividend that has arisen. A taxpayer can make this application if he or she cannot satisfy all the conditions in the self-corrective option, or where he or she satisfies all the conditions in the self-corrective option and just wants written confirmation that the discretion is in fact exercised.
Matt, the final practice statement now contains a lot more details of what the Commissioner would consider to be a Section 3 loan, doesn't it?
That's right, Tracy. The final practice statement also clarified a lot of the details in relation to Section 3 loans, that is, UPEs which were not placed in a sub-trust for the sole benefit of the private company beneficiary. The practice statement now contains a detailed timeline illustrating the key dates where the related entities need to take action in order to avoid Division 7A consequences.
So give me an example that demonstrates what you're talking about.
Okay, so let's consider a family group with a trust and a private company as one of the beneficiaries of the trust. On 30 June 2011, the trustee decides to appoint all of its net income to the private company beneficiary and the amount remains unpaid. If the trustee decides to put the amount on sub-trust for the sole benefit of the private company, then the practice statement says that for UPEs arising in the 2010 income year, the trustee has until 30 June 2011 to put the amount on a sub-trust, or the lodgement date of the trust return for subsequent income years. For a 30 June 2011 distribution, the trustee will need to put the amount on a sub-trust by the lodgement date of the 2011 trust return. On the other hand, if the trustee does not wish to put the amount on a sub-trust for the sole benefit of a private company by the lodgement date of the 2011 trust return, then the UPE becomes a Division 7A loan in the 2012 income year, and the trustee has until the lodgement date of the 2012 private company return to either pay out the UPE or put the amount on a Division 7A complying loan agreement.
And the practice statement actually sets out 3 safe harbour options for the trustee to invest the amount held on sub-trust into the main trust, doesn't it?
That's right, Tracy. These are the investment options which the Commissioner would consider to be commercial in nature. The options are a 7-year interest-only loan with interest payable at the benchmark interest rate, a 10-year interest-only loan with interest payable at the RBA small business variable overdraft rate, and an investment in a specific income-producing asset or investment. Now, if a taxpayer chooses to adopt one of these investment options, and the taxpayer is subsequently subject to an ATO review, the ATO will not question the commercial nature of the sub-trust investment. The practice statement outlines in detail what the Commissioner would expect to see in relation to each of these investment options, including the need to pay the annual return to the private company.
And can they choose to enter into an alternative investment arrangement or just one of these 3 options?
Taxpayers are not required to invest the amounts in the sub-trust using one of the investment options just referred to. However, a taxpayer who chooses to enter into an alternative investment arrangement will be required to show evidence of the commerciality of the investment if the taxpayer is subject to an ATO review at a later date.
After the practice statement was issued, as you would know, representatives from the ATO have taken part in public seminars held by the Tax Institute of Australia and the Institute of Chartered Accountants. What's been the outcome of that consultation?
Tracy, as a result of the questions received in these seminars and other forums, the ATO will be publishing a fact sheet to address some of the more common questions that were raised in relation to the ruling and the practice statement. In addition, we will also be issuing an updated version of the practice statement to include a further example which highlights the interaction between Taxation Ruling TR 2010-3 and Section 109 XI of the Income Tax Assessment Act 1936.
There are a few other Division 7A issues that I know you were keen to raise today, and the first of these is Section 109 XI and Draft Tax Determination TD 2010 D9.
Section 109 XI of Subdivision EB is part of the amendments to Division 7A, which were passed by the Parliament in June 2010. The provision is effective from 1 July 2009. Subdivision EB contains an anti-avoidance provision to ensure that the intent of Subdivision EA is not frustrated. Briefly, Subdivision EA applies where a trust makes a payment or loan to or forgives the debt of a shareholder or associate of a shareholder of a private company, and that private company is either presently entitled or becomes entitled to the net income of the trust. Prior to the introduction of Subdivision EB, one of the ways in which a taxpayer could frustrate the application of Subdivision EA was by interposing one or more trusts between the private company and the trust, as shown on the diagram.
And the situation now?
Section 109 XI now provides that, in such a situation, the private company is taken to be, or to become entitled to, an amount from the net income of the target trust, provided specified conditions are satisfied. Where the conditions in subsection 109 XI1 are satisfied, the Commissioner is empowered, under subsection 109 XI4, to determine the amount to which the private company is taken to be, or to become entitled to, the net income of the target trust.
So what's the central issue here?
The issue is that the legislation does not provide sufficiently clear guidance on the factors which should be taken into account in determining the amount. The Commissioner is mindful of the taxpayers' and practitioners' need for certainty on how the Commissioner will administer the law, particularly where the amounts of the unpaid entitlement are not the same all along the chain of trusts, due to either partial or full payment of certain entitlements. In view of the concerns expressed by the tax community, the Commissioner issued Draft Tax Determination TD 2010-D9 on 15 December 2010. It outlines the factors the Commissioner will take into account in determining any of the deemed entitlement arising under Section 109XI. The due date for submissions for the draft TD has passed. We have received a number of submissions from the public and we're currently reviewing these. We expect to issue a final tax determination before the end of the financial year.
And the next one you want to mention is Section 109T and Draft Tax Determination TD 2010-D10, also issued on the 15th of December 2010.
That's right, Tracy. TD 2010-D10 expresses the Commissioner's view on the factors which the Commissioner will take into account in determining an amount of any deemed payment or notional loan that arises under Section 109T. Briefly, Subdivision E is another anti-avoidance provision which is concerned with back-to-back arrangements under which a private company pays or loans an amount to an interposed entity on the understanding that the interposed entity or another entity will pay or loan an amount to the shareholder of the private company as shown on the diagram. In this situation, Section 109T provides that Division 7A will operate as if the private company makes a deemed payment or notional loan provided that certain conditions are met. As in subsection 109XI4, the legislation contained in sections 109V and 109W provides that an amount of the deemed payment or notional loan is to be determined by the Commissioner.
Why was this TD issued?
The Commissioner issued TD 2010-D10 to provide taxpayers and tax practitioners with further guidance on the factors which the Commissioner will take into account in determining the amount of the deemed payment or notional loan. Some of the factors include the amount or the nature of the payment or loan, such as whether the loan from the private company to the interposed entity meets the criteria which are set out in Section 109N at that time, or whether the payment made from the private company to the interposed entity was converted into a Section 109N compliant loan. The due date for submissions on the draft TD has also passed. We've received a few submissions and are currently reviewing these submissions. We also expect to issue the final tax determination before the end of the financial year.
And just to finish, Matt, you wanted to mention the Commissioner's discretion under Section 109RB to disregard the operation of Division 7A.
The Commissioner issued Taxation Ruling TR 2010-8 on 15 December 2010. The ruling sets out the requirements that must be satisfied before the Commissioner is empowered under Section 109RB to disregard the operation of Division 7A. The Commissioner has also issued a practice statement outlining the process he undertakes when considering a request to exercise the discretion. The practice statement also sets out the factors which the Commissioner considers as relevant when determining whether or not the discretion should be exercised.
Okay, Matthew, an awful lot of information there, so that's where we shall leave it. And links to TR 2010-8 and the practice statement have been provided on the same webpage as this presentation. Matthew Umina, thanks very much for your time.
Thanks, Tracy.
And that concludes our webcast for today. I hope it's been both informative and useful for you. Before we finish, just a reminder to keep an eye out for our next webcast, due for release in June, and that will include important changes for Tax Time 2011. There'll be further details provided in the coming months. Now, on the webpage from which you accessed this webcast, there's a feedback link which details the type of feedback that we're keen to receive from you. So please email your thoughts, suggestions for future topics, or any questions you'd like to be considered for inclusion in future webcasts to tax practitioner presentations at ato.gov.au. Thanks for watching, and I'll see you next time.